Most investors think you have to buy a property to profit from it. Well, you don't. That belief is costing you thousands every single month in missed returns, and I'm going to show you why a master lease option can generate 4 times the cash flow of a traditional rental on the exact same asset with zero money down and full control. Stay tuned. Until then, like this video, subscribe to the channel, hit that notification bell so you don't miss the next video. Share this with your friends. I'm Bud Evans. I'm a 35-year Air Force veteran. I'm a 13-year law enforcement veteran. I'm a former mayor of a small New Jersey town. And I'm an active real estate investor in single-family and small multifamily properties across 4 states. I founded a low-cost investor-focused property management company, by veterans for veterans, by investors for investors, and I mentor veterans and first responders in real estate. If you want one-on-one coaching, visit budevans.com. It's a one-off call. I don't sell a program. All right. Here's what most investors believe. You buy a house, you get a mortgage, you rent it out, you collect the spread. You call that cash flow. And over time, someone else pays down your loan and you build equity. That's the textbook formula. And it works. And most people who own rental properties never really question it. It's just how you're supposed to do it, right? But I want you to look at something else. I want you to look at the numbers here. Let's say you buy a 3-bedroom house in a decent market. Purchase price is $150,000. You put down 20%. That's 30 grand. You get a mortgage at 6.5%. It's a pretty standard rate today. Your payment is $780. You rent the house for $1,200 a month. Your gross spread is $420. But wait, you have property taxes, you have insurance, you have maintenance reserves, vacancy, capital expenses for the roof that's going to fail in 7 years. That $420 goes down to maybe $150 a month in real cash flow. That's 2% cash on cash return on your $30,000 down payment. Well, here's the part everybody ignores. That $30,000 in cash, it's gone. It's tied up. Your capital is pretty much stuck. Now, let me show you what happens when you control the same property without buying it. A master lease option is 2 separate agreements. First agreement is a long-term lease, usually 3 or 10 years. You negotiate the right to lease the property from the owner. You pay them a monthly payment. The second agreement is an options contract. You lock in the right to purchase the property at a given price at any time during that lease period. Here's the key difference. You don't need a down payment. You don't need to qualify for a loan. You don't need a lender. You take full operational control of the property immediately. You can refinance it, repair it, rent it higher, or exit the property. The owner keeps title on paper, but you keep the profit. So let's run the same numbers with this structure instead. You approach the owner, that same $150,000 property. Maybe the owner is a small landlord, mom and pop. Maybe they inherited it. Maybe they just wanted passive income instead of dealing with tenants. You propose a 3-year master lease option. You agree to pay them $800 a month fixed. You negotiate an option price of $140,000 or $150,000. It's below today's market because the owner likes having a credit tenant who takes care of the property. You pay 0 down. You pay 0 closing costs. Now you rent the property out. And you get $1,250 a month because you're managing it right and you've improved it. Your payment to the owner is still only $800. Your spread is $450. After taxes, insurance, maintenance reserves, vacancy, you actually pocket $250 to $300 per month. That's real cash flow. But here's what changes. You paid nothing down. You have 0 capital at risk. That means your return on investment is infinite. You're generating cash flow on money that's not your money. Every penny you paid into that deal came from the cash flow itself. And you can do this on 10 properties, 20 properties, 50 properties. Doesn't matter. The capital isn't the constraint here. Your time is the constraint. Your ability to find good owners and structure good deals, that's the constraint. That's the difference between traditional buying and master lease options. But most investors, they never even consider this path. Why? Because they were taught one way. Pre-approval, down payment, mortgage. That framework worked when interest rates were at 3%, 4.5%, and down payments were relatively affordable. The cost of it has changed too. Strategy, you have to change with it. Now, if you're a veteran and you're serious about scaling beyond 1 or 2 rentals, you need to be in the War Room with David Perret. It's a community of veterans building real wealth through real estate. You'll see deal structures that actually work, and they're not always the standard. You'll network with people who are executing right now. So head over to the War Room. That's where serious investors connect. And if you want personalized coaching on your specific situation, visit budevans.com for a one-off coaching call. Both of those links are in the description. Now, let me walk you through how this actually works. Step 1, find the right property. It doesn't have to be perfect. It just has to be occupied by a tenant who pays rent. You want a property where the owner is tired. Maybe they're out of state. Maybe they have inherited it and they don't want to manage it anymore. Maybe they own 5 properties and one of them is the problem. Target small landlords, mom and pop owners, not institutions. Institutions have servicing agreements that prevent lease options. Small owners have flexibility. Step 2, run your numbers backward. You know the market rent. You know what a mortgage would be. You know what your target cash flow is. That tells you what you can afford to pay the owner. You also know what the property is worth today, and you know what it might be worth in 3 years. That tells you what option price to propose. If you're buying a master lease option, you're not trying to steal the property. You're trying to create a win-win situation where the owner gets passive income and you get the cash flow and control. All right, here's a real-world example. I knew a deal where the owner paid $850 a month on a mortgage. The house rented for $1,300 a month. The owner hated managing the tenant. The property was in pretty good shape. I proposed taking over the lease at $900 per month with a 3-year option to buy at $168,000. The owner got $50 more per month than their current mortgage payment. They got rid of the tenant calls. They know I'm taking care of the property. I'm generating $200 to $250 a month in cash flow, and it's a clean deal. Step 3, document everything. You need a real estate attorney in your corner for this one. They have to be in your state to draft your master lease option. Do not use a template from the internet. ChatGPT does not work here. Your state may have specific requirements. Some states require recorded lease options, some don't. Your attorney will need to handle this. The lease agreement needs to be airtight. The options contract needs to be airtight. You need to document your right to make improvements. You need to document what happens if the owner stops paying the lender. This is not the place to save $500 on attorney fees. Step 4, take operational control. This means you go out and you get the property inspected immediately. You get the title report. You verify that there are no liens or second mortgages that would interfere with your position. You set up property management or you manage it yourself. It really depends on what you want to do. You raise the rent to market if it's below market value. You make repairs that will make economic sense to you. You track every dollar that flows in and out. Here's where most people fail, though. They think a master lease option means they can just sit back and collect checks. It doesn't. You're the operator. If the roof leaks, that's your problem. If the tenant doesn't pay, that's on you. If the property burns down, that's on you too. You need insurance. You need to understand every line item in your profit and loss statement. The advantage is that you're not financing it. Your leverage is not debt. Your leverage is operational excellence. Step 5, execute your exit. This is critical. A master lease option is not forever. You have a fixed term, usually 3, maybe 10 years. You need to decide before year 3 or before year 9 exactly what you're going to do here. Do you exercise the option and buy the property? Do you sell it to another investor who buys into your option? Do you hold through the lease term and let the option expire? It's up to you, but you need to make that determination. If you exercise, you go to a traditional lender with 3 years of documented cash flow. Easy. The property has appreciated. You've proven that you can operate it. Now you get a mortgage based on your track record, not on a down payment. Use a DSCR loan and you have to put nothing down. If you sell the option, you sell the lease and the option together to another investor. You probably keep your profit, most likely. You redeploy your capital to the next deal. If you let the option expire, you've generated 3 to 5 years of cash flow and you walk away. The owner gets back the renovated property with a proven tenant relationship. Everyone wins. But here's a mistake I see consistently. Investors fall in love with the property. They get emotional. They assume the option price is a guaranteed purchase price. Guys, markets move, interest rates move, your cash flow might get better, it might get worse. You need to stay flexible about which exit you're going to take. The option is the tool to generate cash flow and control. It's not a prison sentence. You're not handcuffed to it. Underestimate tenant quality. When you're paying the owner a fixed payment, your profit comes from operational efficiency. One bad tenant kills your equation. Your tenant needs to pay reliably. They need to take care of the property. You need to screen them the same way you would screen any other rental tenant, maybe even better, because your profit margin is tighter. Another mistake here, not planning for capital expenses. You took 0 down because you put nothing into the deal, but the property still needs a new roof in a couple of years, or maybe a new HVAC, or maybe it needs parking lot repair if it's a multifamily property. You need to reserve for that. Your cash flow number needs to account for real maintenance, not just what you think it might be. One more mistake. Forgetting about the due on sale clause. Guys, this has happened to me. Some lenders put a due on sale clause in their owner's mortgage. That means if the property transfers ownership, the lender can call the note. A lease option doesn't transfer title, so technically it shouldn't trigger the clause. But some lenders have gotten a lot more aggressive. You need to talk to your attorney to advise you on this. You might need to disclose the option to the lender. You might need to get lender approval. This will vary by state, but don't skip this step in your underwriting. All right, as always, here's an execution checklist. Identify properties with a passive income. Research the owner's mortgage history and the payoff timeline. Run your numbers backwards from the market rent to determine what monthly payment you can afford and what option price makes sense. Engage a real estate attorney in your state to draft a master lease option agreement, then get the property title report and verify that no liens, second mortgages, or open permits before you actually execute. Set up the property management or personal management systems immediately. Raise rent to market rate if it's currently below market. Execute your repairs that make economic sense, not cosmetic improvements. Track all your cash flow and your expenses in a simple spreadsheet monthly. Plan your exit strategy at year 2, not year 3 when it's due. Decide whether or not you're exercising, selling, or letting that option expire. Screen your tenant the same way you would for a traditional rental. Reserve your capital expenses in your annual cash flow projections now. Stay in compliance with your state's lease option due on sale clause requirements and check with the lender. Hey, if this helped you out, do me a favor, like the video, subscribe to the channel, share this with your friends, and hit that notification bell so you don't miss the next one. That's all for today. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.